welcome to today's segment of The Power of Money. I'm your host, Michelle Graves, and as always, I'm honored, privileged, and delighted to bring you, my faithful viewers, timely information on subjects and people that you want to know. And today I am just amazed and extremely delighted to have in the studios for the next hour two people who have traveled from great distance to talk about a critical subject facing our citizenry today, and that is the reverse mortgage product. You talk about bad information, misinformation, no information. I can't even talk about my irritation and, frankly, annoyance at the way this subject has been so mishandled, something that can change the lives of so many people. And I'm telling you from my own personal experience, I've seen it for myself. So off with the hype, down with the misinformation and bad information. We brought two of the top people in the United States to talk about for the next hour the reverse mortgage product, what it is and what it is not, so that you can begin to make the appropriate financial decisions for your family and maybe even, if you're a senior, yourself. So without further ado, I am going to introduce my next two guests, Don Graves, who is a home equity retirement consultant, one of the top trainers in the United States, training attorneys, CPAs, and financial advisors, been in the industry for well over a decade, knows what he's talking about, high demand individual. He'll be bringing the relevancy of the product, and then and he's from Philadelphia, Pennsylvania, just so that you know. My other guest is also a person of tremendous credentialing, and her name is Shelley Giordano, and her specialty is she's the founder, did you hear me, viewers? She's the founder of the Home Equity Retirement Specialist designation. She's not any nonsense either, and her company operates out of California. So again, California's always been a pioneer in everything, and certainly the reverse mortgage product is no exception. So without further ado, I'm going to get right into the meat of the program. You want to sit down, you want to call your friends and tell them to get a pen or pencil out and a piece of paper, because we are going to really look at this program and this product. I want to, as Michelle Graves, the money lady, I want to cut through the serious misunderstandings so that you can begin to look at your own family situation. Because let me tell you something, when the rubber meets the road and you're having tough financial problems, you don't need to hear Aunt Nellie's advice. And you don't need to talk to your local newscaster for advice. You need to go straight to the source. So as you can see, I'm passionate about this, and I'm excited about them. Don Graves.
Michelle Graves.
And Shelley.
Hello. Thank you for having us, Michelle.
I'm just so delighted and honored that you came to explain this program. So let's start with you, since you are the authority in some ways on this product. Excuse me. Let's start with what is a reverse mortgage.
Thanks for having me on the show, Michelle. 14 years I've been doing this. I've now sat with some 4,400 people, and you may need some water. This subject may, I've had this reaction before when I've talked to people.
You are so funny.
I've talked to, consulted some 4,400 people. About 2,200 have actually gone forward and done the product. And here's what it tells your listeners. As wonderful as the reverse mortgage is for many, it's not always the right decision for people to make. So your listeners want to know, you want to have accurate information, you want to get all the truth and the facts, and at the end of the day, it may not be the right resource for you. So what we want to cover today, and you may want to get some tissue right there. And
You are
now,
so observant.
well, I don't want you to. I don't want your viewers to think that I've caused you to. Yeah, I've caused you to cry. But by the end of our time today, your viewers will know what a reverse mortgage is, how it works, is it the right thing for them or a loved one to do, and is it the right time to do it? Because it could be the right thing to do, but not the right time. What is a reverse mortgage? Since 1988.
1988.
1988. So we've had 26 years as a federal program. So it didn't just happen. Some people have seen Fonzie or a senator or all types of people, Trapper John, MD. But it's been
Yes.
around 26 years. So since 1988, a federally insured program, FHA, that allows senior homeowners age 62 or older the ability to convert a portion of their home's equity and turn that into tax-free money without having income qualifications to qualify, without minimum FICO score requirements to qualify. You don't give up ownership of the home, and you don't make any monthly loan payments.
Let's stop right there.
Let's
I want
pause.
you to go back because you've said a lot. No credit,
No credit score requirements,
no credit score requirements, no income
no income requirements.
requirements.
Now, there may be a change in 2014 where they're going to make sure people have enough income to pay their taxes and insurance, which naturally someone would want
Okay,
to do
their
that.
home, their
their
real
home- their
estate
property
taxes,
tax.
their property
That
taxes.
change hasn't come yet, but there's some thinking about that, and that's just common sense. You would want that.
You would.
For now, so no FICO credit score requirements,
Okay.
no income requirements.
Okay.
You don't give up ownership of the home. No one comes off title of the home, and most importantly, you don't make any monthly loan payments.
It's important about the no one comes off of title because one of the bad information snippets was that you lose your home. And that's not possible if you remain in title.
Right. There was some discussion in years past about people coming off title. In every industry, you'll have some people, doctors, lawyers, mechanics, who may not always be ethical people.
Correct.
So there certainly has been some limited exposure to people who are unethical, but it's never been an industry practice. But it's very important. You do not come off title of the home, and if a listener has ever been encouraged to come off title to the home, they should take serious concern with that and have nothing to do with that lender. Now, the amount of money a reverse mortgage makes available, so people will say, well, how much money can I get? How does it work? And if they're doing the slides, this would be slide number 3. The amount of money that a reverse mortgage makes available to you is based off of 3 things: the age of the youngest borrower, the older you are, the more money you get, number 2, the value of your home, and number 3, the interest rate associated with the program. And that's called the expected rate. So those 3 things, the value of the home, the age of the youngest borrower, and the interest rate associated with the program, will make a certain amount of money available to you. Your clients can have it as a lump sum, which we don't recommend. I personally don't recommend that. That was, again, part of the industry that has changed that we'll talk about. A line of credit or fixed monthly payments. Those
So
are the most...
those are the 3 options, kind of. If they can take it as a lump sum or not.
They can take it as a lump sum.
Okay.
The changes that have occurred since the president signed a new bill into law last October is if you choose the lump sum, for the majority of people, it's going to be throttled down. So it's not going to make as much money because FHA is discouraging people taking all the money out in a lump sum, returning to the program's original intent, which is to be able to use the housing asset to provide a strategic advantage so people can enjoy all of their retirement. You may not believe this, but people would take out a whole lump sum and they'd buy their granddaughter a Princess Diana wedding. They'd buy their grandson a 2 or 3 Corvettes, and then they wouldn't have any money left to pay property taxes or insurance. So that had become problematic enough that Congress, Senate, and the President got involved to say, we're going to throttle that down. So the most common uses are going to be the line of credit or fixed monthly payments, but the line of credit is predominantly the most important.
So let's talk about this line of credit, because the concept of the lump sum, which I am familiar with, and yes, seniors were absolutely, in so many cases, pressured by family to make cash distributions, to bail people out, to fund college. And the poor little widow, which many of the benefactors of this program were women, widows, found themselves penniless, having given away all their money and then not having adequate funds to pay the property tax and insurance, etc. So I totally support Congress's decision to throttle that down, as you say. The second thing, though, is a line of credit. Would you please explain how that works, and is that the same as the bank product, the traditional bank product, where a person has a line of credit, also known as a second mortgage, against their home, which allows them to pull down money as they need? Is that what you're speaking of?
I'm going to ask Shelley Giordano to explain the similarities and the differences. She's done a lot of research on that, and on her site, fundinglongevity.com, you'll be
Funding Longevity.
Sure.
Funding Longevity.
So Shelley, talk about
The line of credit. So you're exactly right. You know, try to make a comparison here between the HECM, home equity conversion mortgage, reverse mortgage line of credit versus a traditional second mortgage or HELOC. People may know them as HELOCs. So the differences are pretty stark. The HECM, reverse mortgage line of credit, is set up and cannot be canceled, frozen, reduced in any way. That's the number one difference. And so that will harken back maybe to some of your viewers' experiences when we had the banking crisis, and they may have set up a second mortgage or a HELOC, so that they could move into a line of credit. And just as they needed the money, the banks pulled their HELOCs, or reduced them. And the reason that they did that is because property values in their neighborhood may have dropped, and the banks didn't want that exposure. So that cannot happen in the home equity conversion reverse mortgage. The line of credit is always there. The second difference is that when you set up a line of credit via a reverse mortgage, it actually grows in value, in borrowing capacity. Now, this is something that's difficult for people to grasp, but just think about it for a minute. A reverse mortgage, the amount of money that you're eligible for is based on your age. So the older you get, the more access you have to your own home equity. So if you're in your 80s, you're going to get more money than somebody who starts out with a reverse mortgage at 62. So for every year that you leave money in your line of credit, your HECM line of credit, it actually grows in borrowing capacity, and the growth is quite impressive. We have amortization schedules, and we can show you a prediction of what your line of credit will look like 5 years down the road, 10 years down the road. Of course, it all depends on what the interest rates are, prevailing interest rates, but we can provide a projection of that. So the two major differences for your viewers is if you're thinking about setting up a HELOC, traditional HELOC, that requires monthly payments
to the bank,
usually interest and principal payments. If we hit hard times again, the bank can come in and pull your line of credit, or reduce it or cancel it. It cannot happen in the HECM line of credit. And thirdly, the amount of money that you're eligible for in a regular traditional HELOC does not grow. And in the HECM line of credit, as you age, you have more access to your housing wealth. Does that pretty much cover it?
That's excellent.
And as I understand what you're saying, because this is so profound about the traditional home equity line of credit, and there was an article that I read which basically said these next 2 years are going to be horrific because people have been doing interest only.
Right.
And now it's got to be amortized. The Fed does not allow evergreen loans, and a lot of people are not going to be prepared for what those payments are going to look like.
Exactly.
Okay.
So yes, so there's been quite a bit of publicity about this recently, and we've had many calls from clients. So what happened is from 2004 until 2008, a lot of interest-only home equity, HELOCs, home equity lines of credit, traditional second mortgages, were initiated, and people have been only required to make interest payments. And so many of them had an interest-only span for 10 years. So there's actually an expectation that from this year, 2014, because we're 10 years out, to 2018, there's something like $258 billion worth of HELOCs that are going to create tremendous payment shock because our clients have been only making interest payments, and now it'll amortize and they have to make these principal payments. And this, of course, is, you know, adversely impacts people who are retired. So you may be getting, if you have one of these loans, you may be getting a reset letter saying, time's up, it's time for you to start making these payments. If it looks like it's going to be a burden to you, you know, please give some thought to at least seeing if you can refinance that HELOC with a HECM line of credit, because if you can do that, you will not be required to make interest and principal payments. You certainly can if you wish to. There's no reason for you not to if it's something you can do, but you can manage the payments. It's a managed payment situation versus you have to make these interest and principal payments.
That's an excellent explanation. Viewers, camera into Michelle. Viewers, you're going to get sticker shock in the next 2 years if you've been in one of those evergreen loans. That's what we bankers call them. And again, based upon what Shelley said, and she's the expert, you can consider and probably should consider doing a conversion or refinancing of your traditional bank HELOC. And it may be a first mortgage as well. And you just consolidate the two of them and refinance them into the reverse mortgage product. See, I bet you didn't know that. Okay, Donald.
Let's finish this because we want to transition to how the product has changed.
Yes.
There's certainly been some changes. But finally, we talked about what is a reverse mortgage, how it works, how much money you can receive, the differences between a reverse mortgage and a traditional home equity line of credit. But finally, when does a reverse mortgage get repaid? The loan gets repaid when the last surviving borrower permanently departs the home, that is, moves or deceases. At that time, whatever money was advanced to the client, plus the interest which has accrued, gets repaid. Very important. And 100% of the remaining equity will pass on to the heirs in the case that the client dies, or to the client in the case that they move. One of the most common prevalent misconceptions that we've heard and you've heard about reverse mortgages is that, oh, that's the loan that the bank gives you the money, but when you die, they take the home. Well, isn't it good to know that that's not true, right? That's
one of those bad information.
It's bad information. When a person moves or deceases, whatever money, think of a Visa credit card. If you had a Visa credit card and it had $50,000, and over time you were drawing on the Visa, but you weren't making a payment, somewhere in the future you're going to owe Visa or whatever more. So if you took out $30,000 and it's 10 years down the road, you may owe them $50,000 as an example. So your house in this case is worth $100,000 or $200,000 and you died. Typically, but not always, typically the children sell the house. The $200,000 would pay off whatever's owed, $50,000 in the example, and the family pockets the difference, which is $150,000. So using the home caused mama to smile, or daddy, met their particular financial needs, and in most cases leaves the remaining balance of the equity to the heirs or to the estate. And that's a very important thing to know.
I think it's not only important, but that is profound bad information that the media has taken and just blasted it. So people are obviously fearful because their family is important, particularly seniors. They want a legacy. And the thought of just losing everything is very, very frightening. So what you're saying is that no, that's not the way it works.
That's not the way it works.
Okay, it works by,
well,
again.
Just what I said. Your home is appreciating in value. To your listeners, you ask the question, have you lived in your home more than 20 years? Then ask them this one question. Is your house worth more than it was 20 years ago. Most people say, of course it is. That's right, because the housing asset is appreciating in value. So we're going to leverage that housing asset, use it to meet some sort of goal or strategy that we have, and we encourage people to use it wisely. Don't go over to the casino and put it all on red. And then mama's reverse mortgages, put it on red. Don't do that. Don't do that. Use it wisely. Use it strategically. And somewhere in the future, whatever you've been advanced, you're going to owe that money back plus interest. But remember, your house also was growing at the same time. And the difference between this and this is what passes on to you, your heirs, or your estate. But here's what's wonderful. The program is changing. And really, and Shelley's here, we want to talk about that because I think your listeners and their advisors, because right now there may be some advisors who are watching.
Correct.
Attorneys, financial planners, wealth managers, CPAs, anyone who's working with people at or in retirement, you want to pay attention right now. Where's a camera I can look at? You want to pay attention right now, because this is very important. Because the program, after 26 years, has taken a wonderful trajectory and a wonderful shift. If they're doing the slides, this would be number 4. Just since
hold on, please. I want to make sure. Can we please see slide number 4? Okay, if possible. Okay. Well, we don't have the cameraman for slide number 4, so we'll just continue on.
Okay. So if they come back, we'll do slide number 4. But here's what slide 4 would say. Since 2011, for most of its existence, most financial advisors, attorneys, CPAs, would have said, oh, we don't like the reverse mortgage. It's a product of last resort. We only would tell our clients to use that when they were down to nothing, that they were squeezing the dollar so tight that the eagle had screamed. But now, since 2011, the Journal of Financial Planning, Financial Advisor Magazine, and all the things which may or may not be on the screen now, countless articles have begun to say we've had this wrong. And that's where Shelley's work has been very profound in the organization and the designation she started and her website, Funding Longevity. Shelley, would you talk about the shift?
Yes. I think to sort of start the conversation, it's important to talk about baby boomers.
Ah, ouch.
Because baby boomers are going to be retiring. And this group, as opposed to the client that we've traditionally served, many of them had pensions, defined benefit plans. And so the baby boomers have come along, and we have been responsible via defined contribution plans, 401ks, and IRAs to sort of fund our own retirements. We've had to save the money. We're not counting on the employer to make sure that we make it through our retirement years. So some baby boomers have done a very good job of saving money, and some haven't done such a good job. So this is what, you said earlier, that it's really critical that people understand what a reverse mortgage is and isn't, because it can really affect the next 30 or 40 years of their lives. So the reason we say that is that academicians have sort of had an epiphany and said, we have all of these baby boomers out there who are not going to be able to fund their retirements because they did not save enough money.
Right.
So let's take a look at the housing asset and see if we can combine the two of them in a way that protects the money that they have saved and yet doesn't do so much damage to the housing asset that you strip through all of your equity. And so that's the work that we're doing with professionals, and in fact the Funding Longevity website really is a site for professionals, and has posted the various academic articles and all the research. I mean, the numbers people who've actually taken a look and have said, you know what, if your portfolio, your nest egg that you're relying on is undervalued because we're in a bear market, don't be selling off in a losing market. Go to this standby line of credit that we discussed earlier and use that money for a while and wait for your nest egg to come back, because when it comes back, then you'll have the returns thrown off from your nest egg that you can go back and continue to live on. So it's the conservative use and the coordinated use of the investment portfolio that baby boomers will be relying on, and many of them, most of them, many of them have a house.
Right.
And so how do you decide from which asset you should draw from? And so that's the basis of all this academic research, and the reason that we're trying to get to the financial advisors and the lawyers and you know, the other CPAs and whatnot who are in a position to help the baby boomers with that critical decision. Do you completely ignore your housing wealth and just go through your nest egg no matter what the economic realities are at the moment? Or do you strategically think about when that housing wealth can help you protect that nest egg?
I think that is so relevant today, because I am a baby boomer.
Me too.
And I know, and you're getting there, sir.
Almost.
Almost.
Not quite.
But not quite, but you're right on the crisp edge.
So Michelle Obama this is the last year of the people who are turning 50, that's the last year of the baby boomers.
Really?
And Laura Bush she was born in 1946, so that was the first year of the baby boomers.
Yes.
So it's an 18-year span. It's a big group of us.
Yes, it
and
is.
we've got a big challenge ahead of us because of the longevity. We expect to be living longer.
Yes.
And we are funding our own retirements.
Which is scary, frankly.
Yeah, exactly.
I mean, it is. When you look at the whole issue of aging and options today, we're the Pepsi generation, whatever that means. But this whole issue of what are we going to do is now upon us. And many of us have had to deal with college and parents and trying to fund and deal with both. And I can tell you that's troubling. So options are important, and I'm hoping, let me turn the camera to myself again, to those of you that are financial advisors and in this industry that I have loved for 36 years, you need to kind of rethink some things. The old way is not working. And again, I encourage and exhort you to go to Shelley's site, which is
Funding Longevity, www.fundinglongevity.com.
fundinglongevity.com, and of course your site.
Very simple. Ask Don Graves.
AskDonGraves.com. And in fact, I did post that last night on my Facebook account to let my followers know that you can look at his site and get information, but now you can also look at her site and get more information. And again, trusted advisors, attorneys, people that seniors trust and believe, you gotta make the shift. Information is powerful, and if you are carrying misconceptions, and today we're living in a time where so many misconceptions are just being blown away, which is, who told you that? And again, I'm just encouraging you to take a hard look. I'm tired of having the conversation with my peers, which is you can't say that because you're not informed. And it's scary when you say things that you're not informed about. So I would encourage you to listen on some more, because we got a whole lot more to cover, and be open to the probability that you have been misinformed and that things have changed. So where do we want to resume?
Are the slides back up?
I'm getting ready to ask, can I get the slides up in the control room, please?
If so, we're going to be on number 4. And I want to piggyback on what Shelley had talked about.
Okay, we're looking at investment news. Is that slide number 4?
Yes. And so we're going to do a series of those. So what we're talking about, the slides that you're seeing now are just saying the industry has changed. The trajectory is now to a more informed borrower and a more informed advisor. The advisor's challenge, next slide, simply says that
next slide, please.
The advisor is going to, you've got investments. The client has income, they've got investments, perhaps they have some insurances. And the advisor's challenge, particularly the baby boomers, right? 10,000 a day are turning 62.
10,000 of us a day.
The advisor's challenge now is, how do I take these 3 buckets and create cash flow for this person that's going to last a length of time because we're living longer. There's a wonderful commercial where they put these dots up and it says retirement for all of life. What's the oldest person that you've ever known? And they have people put this up on a board. And it says your retirement could last 30 or 40 years. So the advisor's challenge, same slide, is to take this pot of money, this resource, this nest egg, to create cash flow for a length of time to give people a quality of life that they're used to and leave a certain bequest if there's something left over.
Okay.
Now the challenges to that are on the next slide.
Okay,
The
next
challenges
slide,
are
please. Okay.
we've got to overcome a few things. Market fluctuations. What's the market going to be? If we have another downturn like we had in 2008, that's going to impact people. So you've got market fluctuations. You've got future tax rates. You've got client spending disciplines. Can we have a person to spend within their means? Because they certainly could run out of money. I know you deal a lot with long-term care and health costs.
Yeah.
One study said we're projected $240,000 out of pocket is what the typical retiree retiring today is expected to spend. Will your nest egg cover that? And then the longevity. So the financial advisor who's watching, who maybe has been trained typically to say, well, the house is an investment. We're not going to touch that. And house is not an investment. It's a non-performing asset.
I like that term. It's a non-performing asset.
That's right. And
Yes.
so it now has to be part of the conversation. That's very important. I want to unpack a few examples. A few questions I received this week. That would be on slide number 7.
Slide
I'm not
7,
going
please.
to go through all of those, but I want to have it up there that if people are watching this in the various outlets live, or they can get it on your website or on the YouTube page, so they
Yes.
can pause it right here. Well, the slide says, here are some questions that I've received just in the last 16 days. The first one I want to unpack. Here's a person, so we can take that slide down and come back because I
Okay.
look good in this suit and tie. And I don't want all this beauty to be covered up with slides. Well, here's a scenario. A client calls and he says, I'm on a fixed income. I've retired, but I've got long-term care concerns. He was strategic enough to have bought long-term care insurance before he retired.
Yes.
But now that he was 70 years of age on a fixed income, he realized, I cannot afford to continue making this payment. So he was
The
paying
long-term care payments.
Just when you
Long-term-
need it.
Right
just
when you
when
need
you-
it, just
yeah.
when you need it.
$7,000 a year. And he says, I can't continue to afford to pay that. He's had Medicare supplement.
Okay,
And he
for
says
his
that's,
healthcare component.
and that was $3,200. So he's $10,000 a year roughly short. He says, so I've got my nest egg. It was down to $130,000. He says, Don, I have to pull out $10,000 a year, roughly $833 a month, out of this nest egg.
And
If
that's
I
all he had.
That's all he had. And he says, my advisor said that you may have a strategy that can help me to stay in my home, cover my long-term care, and save my nest egg. I didn't think it was possible, but Don, are you telling me it's possible? And I'm saying it's absolutely possible. Slide number 8 tells you what we did for this client. Now this is just last week in Philadelphia. Now notice what we did, and for the advisor who may be looking. Through the use of the housing asset, we were able to do a reverse mortgage. It accomplished a few things. Remember, he was short $833 a month. He had a small mortgage on his property, so we paid off a small mortgage. His payment was $200 principal and interest, so we paid that off. Now he's short $633 a month. From the reverse mortgage, he had money left over, and he said, Don, I need this money to provide $633, and the shortfall, how long will it last? We were able to provide 180 months, 15 years worth of payments at $633. Now notice what that did. I think the slide says 177 months. There was an adjustment. So 177 months, roughly 15 years. Notice what happens. Now he doesn't have a shortfall anymore. So his portfolio of $130,000 that he's drawing every month, he has to get $833 but he's going to have to draw about $1,200 because it's going to be taxed.
Right.
He's going to run out of money in about 9 years. Conservatively, he runs
Okay.
out of money in 9 years. With this strategy, we simply used the reverse mortgage to give him a $633 a month payment, to eliminate his existing mortgage payment, and now his $130,000 nest egg can be rebalanced or whatever can be done. It gets to grow for 15 years without needing to be touched. If it grew at 8%, 15 years later it'd be at $412,000.
Perfect.
So now when he's
Perfect.
85 years of age,
And needs long-term care.
he's got a $413,000 nest egg. That's
Right.
at 8% less, if the portfolio gained less. But what were the options? Run out of money at 9 years, or 15 years down the road, have not run out of money and have this large
Nice
nest egg.
portfolio.
You see?
And to be able to continue to pay his long-term care insurance premiums.
Correct.
Because that's a biggie. You don't want to pay into a product and then when you need it, it's lapsed.
That's
Yeah,
right.
I mean,
exactly.
that's just the beginning of a bad story.
Sure.
So you met his objectives.
Absolutely.
Was he a happy camper?
Smiling all the way.
I love it.
Absolutely.
I like
Look-
good
look at-
stories.
Look at the next one, and I'm going to have Shelley to come in because she was very instrumental in helping. She helps a whole industry. The next slide is slide number 9. Now here's a person, he's got $300,000 in an investment.
Okay.
And they say to me, this is the actual quote, well, Don, I've got this mortgage payment, and if I get a reverse mortgage, you're going to pay off my existing mortgage, so I don't have to pay that anymore, but I'm only going to have $7,000 left over after you pay that off. So what good is a reverse mortgage to me? And I smile at the word, that's all I'm going to get out of it. And I said, is that all you're going to get out of it? Now notice, think about this. A person has a $300,000 portfolio. So to some people that may seem like a lot of money. Every month he has to draw $2,000 out of that portfolio to live. And so he's going to run out of money at some point in time, right?
Correct.
And the next slide, we won't go there yet, but he's going to run out of money at some point in time. He has a mortgage payment of $700 a month, of which is principal and interest.
Okay.
If we eliminate his mortgage payment, that means he doesn't have to draw $2,000 a month from his portfolio. He only has to draw $1,300 a month. Slide number 9. Look at the difference this makes. Is it up? I don't want to
Okay.
turn over there and be unprofessional looking all on the other side of the building.
Okay, let me see if this, is slide number 9 Mr. Gear?
No, that Richard
Okay.
Gere's 64. So we're after Richard.
Okay, can we
there,
go to the next slide?
Look at the
Okay,
outcome.
there we are.
Now
Okay,
look at
thank
the
you.
outcome. To the financial advisor, the accountant, you're coming up on tax season, you're working with people, you're looking at their budget, and for the person who doesn't do the metrics, right? That's like going to get your oil change and the mechanic just opens up the lid and says, it looks okay. He never puts the dipstick in, he never. If you don't look at the metrics, you'll mislead, maybe unintentionally, but you have to look at your client to say, what does $300,000 do for a client who's pulling it out at $2,000 a month, assuming the market grows at 6%? That's a big assumption.
That's a big assumption.
That's a big
Okay.
assumption. But it says he's going to run out of money over there on this slide. But by simply reducing him having to take out $2,000 to $1,300, look what happens on the slide. He gains 13, 14 more years of savings for his nest egg. We can pull that slide down because I want them to see all this.
Okay, can we see that slide again?
So we can take
Okay,
that down.
all right.
So, but that's
I see, okay.
That's important to the advisor, and Shelley's done tremendous work about that. Can you talk about
Okay.
plan survivability?
Well, this is a perfect example of
And we can take that one down.
of the power of keeping your money invested. And most advisors will tell you that that they want to do everything that they can to maximize the amount of money that is not being withdrawn. I mean, just simple. It's just
Sure,
simple
sure.
from the portfolio.
They
If
don't like
it's-
money leaving the
yeah,
portfolio.
well, nobody does
Right.
because you miss the opportunity for the compounding growth.
Exactly.
And of course now markets are volatile and all of that kind of thing. But what it does is it improves the probability that people will actually have a secure retirement. I mean, it's no more complicated than that. It's using this other asset to help protect the investment portfolio from the ups and downs of the market, or reducing the amount of money that needs to be withdrawn and then taxes paid on it
Taxes
from
are there.
from your investment portfolio every month. Just has this tremendously beneficial effect. It's just easy concepts, and for some reason we have
How's it
just
been
not.
overlooked? I mean, I'm just confused
yes,
here.
I know.
I'm a money person. I crunch.
Yeah.
And intuitively, when I looked at this years ago, I said, oh my goodness gracious, this is marvelous, because it allows them to leverage an asset.
Right.
And to get money to live on. Of course, people never thought that their pension plans would be history. They never thought that.
Right.
They were always counting on that defined benefit plan.
Right.
And they never thought that the market would do what it would do. But life is always full of curves and surprises.
And that's why the advisors and the people in the financial field and these academicians who are writing these papers, that you can only talk about probabilities.
Right.
The probability that you're going to have enough money to last 30 years, but what if you live 40 years?
Yes.
So maybe we should plan for 40 years. And so your plan looks good. You have a high probability that you're going to have enough money for 30 years, but maybe we should write a plan that gives you a high probability to survive for 40 years, because you may live to 100.
Yeah.
Many of us will.
Many are. Centenarians are
yes.
the fastest growing group
That's right,
in
I
America.
yeah.
They're
So-
living. They're living.
And it is very frustrating to us as well, because you've mentioned your peers and your colleagues who continue to write and say only use a reverse mortgage as a last resort. Well, mathematically, not work we've done, but mathematicians have done, demonstrate that that's really the worst way to use your housing wealth. That if you blow through your portfolio and then you're counting on taking out a reverse mortgage when you're 80 or 85, and it's the only thing that you can live on, you will go through that very quickly
Yes,
as
you
well.
will.
So it's a much better strategy to look at the coordination of those two assets, and use your housing wealth in a very conservative, protracted way, so that it lasts throughout your retirement, which is what FHA originally intended reverse mortgages to be. Unfortunately, they were abused, and people were stripping, equity stripping,
Yep.
and then getting themselves in a situation where they couldn't pay their taxes and insurance, and it was terrible. But we're at the end of that, we think. So
I think we are, because we're in a different season, and I think the play is gone. We're not playing anymore. People recognize the seriousness of the times, and they recognize that you've got to prepare, and therefore you need to get good, solid, sound financial information.
Right.
That is so important today.
Right.
You can't depend upon snippets and looking at television. So let's talk about how this program works.
Which program?
The
We're talking about.
HECM.
I want to give another example. 'cause
Okay, well, that's fine.
You interview lots of people.
Yes, I do.
The Power of Money.
Yes.
The Power of Money by
Yes.
Michelle Graves.
Yes.
That's a powerful name. Do your listeners know that I share the same last name as you?
They don't know this, but I think
Okay.
intuitively they would.
They would. I mean, because that's Don Graves.
Yes.
Under there, and so I don't know protocol, but you advisors have to look at this afresh, right?
I agree.
There's a fellow who was an estate planning attorney, and he said to me, Don, my clients would never need your services, thank you. And I said, well, they probably wouldn't, and most people would not. And I said, but give me an example of a client. He says, well, they're 62 and they're retiring, and they've got $600,000 in assets and a $500,000 home, and they've come to me, and they want me to do an estate plan. I said, what's their goal? Well, their goal is to pass along more wealth to their children and so on and so forth. See, Don, we wouldn't need you. And I said, you probably wouldn't. I said, but would you consider this? I don't know if you would or not, but let's see if it would be valuable to give your clients all the alternatives. I asked him one question: do they have long-term care insurance? He says, well, most of my clients have long-term care insurance. I suspected he wasn't telling the truth.
I suspect he wasn't.
I said, well, what percentage? He said about 20%. Now, I'm from a little town, Falmouth, Kentucky. 20% doesn't equate to most, but
it does not. It does
and
not.
I said, does this couple have long-term care insurance? He says, well, they don't. And I said, they have $600,000 in savings? He says, they do. I said, do you know the odds that one of them will have some sort of issue in their life that will require long-term care? He says, I don't. I said, it's greater than 50%. So I said, as an estate planning attorney, you've left $600,000 fully exposed.
Ouch.
I said, so here's a possible scenario. Maybe we just put it on the table. Suppose your clients were able to use the housing wealth in a conservative and coordinated way. I love those words. And we did a reverse mortgage. And I showed them that the reverse mortgage would make available, if they wanted a 10-year payment, which means for as long as they're in the house, T-E-N-U-R-E, 10-year payment, it would make $1,300 a month available. So I said, write that down, $1,300 a month. And I said, the first thing you don't know is if the $600,000 is really going to last them for as long as they're going to live. I said, you have to do the metrics on that. It should, but we don't know what their budget is. But you've got it exposed, right? So one of them gets sick, has to go into a nursing home. And if they don't do the proper planning, that asset is vulnerable. If they're both in good health, or as I learned, just one of them in good health, I said, if $1,300 a month, and I did the math for him, I said $500 a month will buy a long-term care policy for $200 a day for 6 years. I said, that's going to protect the asset. So now you've protected the $600,000 asset, right? You've protected their money.
Yes.
And what has it cost them out of pocket so far? Nothing. We've just monetized the housing asset. It hasn't impacted their cash flow at all. So you've protected the asset against something that probably will happen. But now we still have $800 left over. If they chose to do a second-to-die life insurance policy, and I did a quote, I said, do you know how much that would make available? $1 million. So here's what you've done with the housing asset. You've protected $600,000. You've given them long-term care insurance, and you've given them an asset to pass on to their children, life insurance, estate tax, inheritance tax-free, of $1 million without impacting their cash flow at all. And I said to him, it may not be for your clients, but wouldn't it be nice just to have it as part of the conversation? That's the impact. That's the trajectory of the program.
And I think you bring up an excellent point for consideration, and that is that as a part of the conversation, as a part of being the trusted advisor, you have to be open to what options are available to the client. They have to feel empowered with complete information to make good, sound financial decisions. It's like the same as going to a doctor today. If you have been diagnosed with a certain condition, you would like to know what all of your options are. You don't want a doctor to look at you, at least I'm a baby boomer, don't look at me and say, we've got this, because I'm going to look at you and say to you that that's not good enough. We don't have anything. Tell me what my options are. And I think that we're dealing with a much more sophisticated consumer today, internet savvy, television savvy, financial column savvy. Those days are where people just trust it intuitively are gone. And the other thing I want to bring to the table is to advisors particularly. I believe they're going to get sued. I said the bad word. You're going to, the family's going to sue the trusted advisor, because the trusted advisor did not explain to their parents that they did not have to go down the road like this. Medicaid will take all of your money. You will zoom through money like nobody's business when you could have had an alternative. And I just believe the heirs and their trusted attorney are going to sue that advisor who did not at least discuss options. It's something to think about.
It's a bit alarmist, but I think the day is coming.
Oh, you at the point you watch $500,000 go out the window because of poor advisory services. I don't think that's alarmist. I think that's extremely realistic, and I think people are going to do it. Okay?
The proactive advisor understands that people are shopping or doing certain things, and they're going to be made aware. At our website, Ask Don Graves, we'll have lots of articles, and it's only for advisors. My website is not for consumers. It's only for advisors. With the time we have left, the 10th or the 12th slide.
Okay, can we go to slide number 12 in the remaining moments we have?
It's very important for the legacy, and it's something we're very excited about, and you and I have talked about it, which is tuition rewards. That is,
I love that.
Tuition rewards is simply a program that's made available for anyone who gets a reverse mortgage through myself or through Shelley's Conduit. They're the only two places in the world you can do that, through us or through Shelley's Resources. For every senior who chooses to do that, we will provide a college scholarship credit of up to $10,000, listen to this, to each of their grandchildren, 12th grade or younger. So if a client comes and she has 10 grandchildren from 9th grade down to 3 years old, we're going to provide her college scholarships. What's the cost to her? No cost to her. 316 colleges and universities in 45 states. We're very proud of it because it's leaving a legacy as we're monetizing the housing asset to meet mom or grandma's need. Grandmother is going to give back to her grandchildren in a very powerful way. You can find out about it at AskDonGraves.com. Click up at the top. It says Heckham College Scholarships. We'll give you all the information. But it's a powerful tool, and it's hopeful. And so I just wanted to say that before we ran out of our time. Shelley, did you have some closing thoughts?
No, just to thank you so much, Michelle, to have this opportunity to speak to baby boomers and to reinforce what you've had to say here, that it's absolutely critical that people get correct information, and it's so hard to come by. So you're to be congratulated for leading the charge here. We appreciate it.
Well, I don't know about leading the charge. I've been doing this for 36 years, and I still remain profoundly amazed and many times annoyed at the closed-mindedness to facts. I mean, you can punch the numbers, and there it is. And my challenge today is just like, and it's not a good comparison, but the drug industry had to go to the consumer to make doctors start prescribing certain drugs. Now, that's not a good, necessarily good analogy, but again, it's my hope that advisors will begin to look at the whole issue of long-term care options and solutions with a much more open-minded and strategically oriented thinking mode that says, you know, this is an option. I want to thank the both of you, Don Graves from Philadelphia, Pennsylvania, Heckham specialist, and Shelley Giordano, who is, did I pronounce it right?
You said it exactly right.
Okay, because it's Italian. As the founder of the Home Equity Retirement Specialist designation, I want to, and from California, and I just want to thank both of you for honoring me with your presence and your time and your commitment to educating my people. And in my case, I waited to try to get you for 2 years. And I was getting a little bit frustrated about this piece. You're a high-demand man. But I appreciate the opportunity today, and it is my hope that my viewers have learned. And in closing out today's segment of The Power of Money, where we talked about understanding the reverse mortgage product, dispelling the myths, the concept, the bad information, the no information, the misinformation, I hope you, as my viewers, have learned a little bit more so that you're in a position to make sound financial decisions. If you're using advisors who say that they're long-term care specialists or estate planning specialists or attorneys, whatever, if they're dealing in the area of aging, they need to be familiar with this product, and they need to know the changes that have been made. It will benefit you greatly to know what your options are. And I love options. I'm Michelle Graves, thanking you for being a part of a remarkable show today. And as always, God bless you richly, and you have a great day. Take care.